All right, I want to talk about this trade I made on the S&P 500 index where I profited $110 after commissions and in less than 2 weeks. So on October 2nd, when the S&P 500 index dropped from 29.24 all the way down to 28.74, I sold the following option trade, or I made the following option trade called the put credit spread. So I didn't buy any stock. I sold the 27.45 put and I bought the 27.35 put for protection. I collected $90 from that trade and the capital invested in that trade is $410. Basically, it's the difference between both strikes. So the difference between 27.40 and 27.35 minus the credit that I already collected of $90. So my capital invested is $410. So the way this trade becomes profitable is come expiration of the options, which was November 15. If the S&P 500 index is trading above 27.40, then this trade becomes 100% profitable. But at any time during the trade between now and the expiration, or between October 2nd and the expiration, the trade can be closed for a profit. So anyways, I made the trade October 2nd and I kept it. And then October 9th, the S&P 500 dropped again. It was trading at around 29.19. This time I sold a put credit spread. I sold the 27.95 put option and I bought the 27.90 put option for protection. This time I collected $86. Also the same expiration of November 15. So since then, the S&P 500 has gone through a rally and went all the way up to 29.95. Even yesterday, it was trading at 3,000. Today, October 16, I decided to close both of these put credit spreads. Although they're pretty far and I still have a lot of time until November 15, I have a feeling that the S&P 500 will drop again. I don't know when, but I have a feeling that it will drop before November 15. And I don't want to regret not closing the trades early for a decent profit. So from both of these trades, I was able to collect $176 combined. And today I closed them together for $50. So that leaves me with $126 minus the commissions of about $16. I'm left with $110. So my net profit on both of these trades is $110. Capital invested for each. First trade was $410. Second trade was $414. So 110 divided by 824 is a 13% return in less than 2 weeks. So what I really love about these trades, credit spreads, is I don't have to buy the stock. I don't have to time anything. I don't have to wait for the stock to drop for me to buy it and then wait for the stock to go up for me to make a profit. I can basically make this trade wherever the stock is trading. If the stock is trading here, I can make this trade. I could sell a put credit spread here. But then yes, I'd be in trouble a few weeks later because the stock would go below my strikes. But if I have time in the trade, eventually it'll go back up, especially if I'm trading the indexes. If the stock is here, I can make this trade. If the stock is here, I can definitely make this trade. And if this stock is here, for example, I could sell the call option at the same time. So I could choose a range where I expect the stock to stay within a certain period. So if the stock is trading at 3,000, I could choose a 3,100 call and a 2,900 put. So as long as for the next 30 days, so as long as the S&P 500 index stays within that range at expiration, then I keep my profit. And at any time during that period, I can close the trade. So let's say I had done an iron condor right over here at 2,900 and 3,100, expiring October 18, for example. As time goes by, my put option is getting tested, of course. As you can see here, it drops below 2,900. Then it comes back up again to 2,952. So when it comes up to 2,952, this gives me a chance to actually close the trade early. So if I collected, let's say $150 with this trade over here, once it gets to 2,952 and time has gone by, I could probably close the trade for maybe $60, $70. Let's say I don't close the trade and hold on to it. It drops again. That's not good. But because I still have time, I could hold on to it. And then as time goes by, it starts to come back up. 29.70, very close to the midpoint. I can definitely close the trade early for a decent profit. And even if I held on to it even more, 3,000. And now with a few days till expiration, both options can expire worthless and I get to keep the full profit. Now, this isn't always the best strategy to wait till expiration. Sometimes it's best to close the trade early for a decent profit if you have the opportunity, because you never know where the stock will be come expiration exactly. But because you give yourself a wide range to begin with, plus enough time for the stock to correct itself, you tend to have odds on your side. So what is a put option? When you buy a put option, it gives you the right to sell a stock at a particular price. Now, if you sell the put option, that means someone bought it from you. So if you sell the put option, you're actually giving the right to the buyer of that put option to sell you his stock at that particular price. So if the stock is trading at 3,000, for example, and you sell the 2,900 put option, that basically means if the stock drops to 2,900, the buyer of that put option has the right to sell you the stock for 2,900. So you will end up with 2,900. So you will end up with 100 shares of that stock at 2,900. So that's how put options work generally. But with a put credit spread, it's called spread for a reason, because you're selling the put option at a particular strike, let's say 2,900, but then you're buying the other put option at a different strike at 2,895. So by buying the put option, it gives you the right to sell that stock for 2,895. So if you're ever forced to buy the stock at 2,900 because someone exercised their right to sell it to you at 2,900, you have that other put option that you bought at 2,895 for protection. So your max loss will always be the difference between the put option that you sell and the put option that you buy, which will be $500 depending on the spread. So if you sell a put option at 2,900, but the stock goes to 2,800, you'd be in big trouble, because then you'd own a stock at 2,900, but you're down $100 per share. So $10,000. But because you buy a put option for protection with a difference of only $5, for example, then your max loss is $500. But by actually placing this trade to begin with, you're getting a credit, because you're selling a put option at 2,900, but then you're buying a put option lower at 2,895. So the difference in premiums ends up being a credit. That credit is yours to keep as long as the stock remains above your short strike come expiration. Short strike being the strike that you sell, the put option that you sell. Now, a call option. What is a call option? If you buy a call option, it gives you the right to buy a stock at a particular price at the chosen strike of that option. So if you're selling the call option, that means you're giving someone, the buyer, the right to buy the stock from you at a particular price. So you have to be ready to sell. You have to be ready to sell 100 shares of that stock at that strike price. So if you sell a 3,000 call option and the stock goes above 3,000, then you're forced to sell 100 shares of that stock for 3,000. But what if you don't have 100 shares of that stock? So what's going to happen is your broker is going to let you borrow 100 shares of that stock. You're going to receive the funds of 100 shares, and then it's up to you to cover your borrowed stock. Thing is, the stock might end up at 3,100. You've received money for only 3,000. So now you have to cover the difference. So that's why when you do a credit spread and you sell a call option at 3,000, you buy another call option at 3,005, for example, to limit your risk. So you're buying that second option for protection. So even if the stock goes to 3,100 and you're forced to sell stock at 3,000 because you bought a call option at 3,005, the most you'll pay is 3,005. You received money for 3,000, so your max loss is the difference, $500 again. So that's how credit spreads work, and I just wanted to share with you how I was able to make what I think is simple profit with this put credit spread on the S&P 500. Honestly, it didn't take much effort. I just saw the S&P 500 drop. I assumed that it's not going to drop forever unless we're crashing. So I sold a put credit spread further than the price that it was trading at, collected a decent premium because volatility was high. And then when the market just corrected itself and went back up again, was able to close out the trade for a decent profit. So if you have any questions, leave them in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.